listener of Awesome 10X Global Market Updates. So from Monday to Thursday, we will continue streaming 2 p.m. Philippine time with the Awesome 10X Global Market Updates. But on Friday, we will just simulcast a free Friday class to everyone. So there will be no 2 p.m. Global Market Update. Similarly, for the Philippine market updates, we will just do it solely on Monday, every 1:30 p.m. on Monday. Instead of getting a random market update every single day, we'll give you deep dives on specific companies. So once a week, we will do a Philippine deep dive for you. It's not going to be as long as an hour. Maybe it's going to take 30 minutes, but we want to actually help you to get a lot of ideas for your Philippine markets, not just basing on the charts, but actually what the company in the Philippines is actually doing. So it's more like a 30-minute deep dive on the Philippine markets, which we feel will give you more value rather than a 30-minute market update about the constant gyration of Philippine stocks. Hope that helps you. Okay. All right. So let's discuss the the global market updates. So today's topic is interesting because we want to answer this basic question. How did Roaring Kitty actually make $25 million off of GME? He only had $25,000. How did he do that? So to answer that question, you have to understand the black swan, and you also have to understand options. So the category today is we're going to discuss options. Now, a lot of people have always asked me, Nikki, how do I use these options? So let's discuss. You could see in the news articles that as of April 16, there was actually Roaring Kitty. This is Mr. Roaring Kitty. That's his YouTube channel, by the way. So you can actually follow him in case you want to listen to him straight. Why did he rake in a lot of millions of dollars on his GameStop options? Keith Hill, better known as the GameStop bull, could bring in more than $7 million as the options that he bought at the start of the year is going to expire. As CNBC reported earlier, Keith Hill, known as the Roaring Kitty and Deep Fucking Value on Reddit's Wall Street Bets, owns 500 contracts of April 16 call option contracts with a strike price of $12 per share. So Keith Hill paid 20 cents, so that means 500 times 20.2 times 100 shares. So each contract allows him to buy 100 shares of GME at $12 price per share. He bought it at the beginning of the year, let's say January 4, 2021. Right now, GME is sitting around $156 per share. So what exactly is the value of his call options? First and foremost, let me explain this to you in mathematical terms. So, of course, we knew that he was a long-time bull already of GME ever since. And we were also actually saying in our Awesome 10X class that when the NASDAQ was at 12,000, we were saying that one of the great long ideas was to actually go long GME. If you wanted to check out that class, just go to, I'll give you the exact, I'm going to highlight to you that Awesome 10X also detected the great opportunity on GME. However, we weren't actually using options then. We were just doing longs, like really stocks. So simple, right? So Awesome 10X, NASDAQ, 12,000. What's next? So go to this, actually go to my YouTube channel. Wait up, let's see. So I can't remember the title, but let's go to my YouTube channel, Awesome 10X. And then, so you click this, you'll see that we've made a lot of playlists. So it's really assorted. So buy the Awesome 10X Global Stock Picks, free Friday play masterclass, similar to this one. So we had, by the way, this is not the first day that we are discussing options. We discussed how to sell put options here as a strategy. And I'll discuss it again, don't worry. And then we also shared here 12,000 NASDAQ. What should you buy after the sell-off? What is next on 12,000 NASDAQ? And we argued actually on this area to actually be buying companies such as GME because of the short squeeze possibility. So the people who actually are looking to really study the markets will be heavily rewarded. So if you are watching me, you will learn how to make money. So this is what Keith Hill did. He owns 500 contracts of April 16, 2021 call options. What's important here? You know that the strike price is $12. So 500 means that he has the right. So call options means I have the right to buy, to own 500 times 100 or 50,000 shares because each contract is 100 shares. I can buy 50,000 shares at $12 for only as for giving him $10,000. So if he wants to enact that on April 16, 2021, he pays 50,000 shares times 12 or $600,000 worth of stock of GME. His total cost then will be 600K plus the 10K premium he paid for that, right? This is his supposed total commitment. He has to come up with $600,000 on April 16, 2021. Now, what exactly happened? Today is April 16, 2021. GME shares are actually $156. The intrinsic value of those 500 contracts is very simple math. Today's price is $156. The strike price is $12. That means for each contract, the price is $144. Something that he paid 20 cents for has now an intrinsic value of $144. Now, he has 50,000 shares. Multiply 144 times 50,000 shares, it's actually $7.2 million. Right? 144 times 50 is, let me get my calculator. See, God, it's up. Yeah, that's $7.2 million. So that's not 7M, that is $7.2 million. So even if he pays $610,000, what is his effective gain? $7.2 million minus $610,000 is a whopping $6.6 million. So whoever he dealt with should give him 50,000 shares. We learned afterwards that the one who he dealt with was actually Melvin Capital Hedge Fund. So Melvin needs to give 50,000 shares, or roughly at 156 price, about $7.5 million already to Roaring Kitty, also known as Deep Fucking Value, also known as Keith Hill. So even if his technical cost is $600,000, he made over $7 million in that single trade. It's very nice, right? That's why Keith Hill bought a nice house. That only happens because on expiry date, any rational human being will, of course, exercise that right to actually buy those 50,000 shares and get his money. Now, what's the lesson here? The lesson here is do not sell calls if you do not have the shares. Only do covered calls. Why did Melvin Capital lose a lot of money? Because he sold a call. He got $50,000, right? Sorry, $10,000. Because when Keith Hill bought that 500 call options, he had to pay how much? 20 cents times 500 contracts times 100 shares is $10,000. So the other counterparty apparently didn't have 500 or 50,000 shares. So he was caught short without 50,000 shares. And therefore, on April 16, 2021, he had lost, the other side lost over $7 million if he were to buy 50,000 shares from the market itself. So what we are teaching people is the definition of covered call options. What is a covered call option? A covered call option means that you've got a strike price. In this case, example, if I have GME, at $6 cost, let's say, and I want to ensure myself that I could sell my GME at $12, I'm gonna sell a call at, say, in that case, it was a 20 cents. But normally, I don't engage in that little of a call. What exactly did Keith Hill do? He bought an out-of-the-money option. I'm sorry if this one looks so gulo. I'm not sure if you understand me. So in order to understand me, we will make a lot of examples. So stay there. Selling options is a consistent way to generate excess income for a trader But writing naked options is extremely risky if the market moves against you. What happened here was selling calls. The person, Melvin Capital, didn't have 50,000 GME shares. That's why he had so much risk. Whereas if you have, example, 100 shares of a company and you think that that company is not going to go beyond $100, you can actually make a sell call strategy work for you. And that's what we will explain to you today. Writing naked calls and puts will return. So writing means selling. Selling calls or selling puts will return to you the entire premium collected by the seller of the option only if the contract expires worthless. Covered call is a selling strategy of options, but it is involving against an existing long position. So we are teaching, we actually teach people to do covered call, and I'll do it exactly for you. So example, if I was bullish long-term with Copin since 2020, and you knew that I was bullish Copin and Vuzi. Instead of example, if I have $10,000 of Copin, I could, at that price, at that point in time when we were bullish, it was July 2020, Copin shares was just trading at $1, $1, 1.1, 1.2, 1.3. So for a simplistic state, it's $1. So I could buy 10,000 shares of Copin at 1. Now, let's assume that if I think that Copin is going to go $2 to $3 in the next year, I could have done something like this. I buy a 1-year call option to buy 10,000 shares of Copin at $3. If it's 10,000 shares that I want to buy, that means I need to buy 100 contracts at $3 strike because that's where I want to pay for. Now, you might think, why would I buy an out-of-the-money call option? It's because I'm very bullish about that company. The reason why Mr. Keith Hill bought 20 cents out of the money call options on GME strike price 12 is because when he was doing that, what was the price of GME? Let me share to you the price. The real price of GME during that time, if you go back to history, is just around, so we go back to January, okay? This is January. Actually, it's a bit weird because GME was already trading at 18. So it's not even out of the money. It's already in the money. So most likely he got in not really exactly that price. I'd say that he got the 20 cent call option. He probably purchased it when the prices were still at about $6, $6 or $7 or $5. So we knew that he was buying very early on, even before 2020. Keith Hill was buying so many GME shares already. Now, here's what we're doing. No, example for Copin. Let me explain to you. For purposes of example, and also we're gonna do a real trade in front of you. Okay, so we were bullish since July, and it was here about $1.30. So if you're buying a 1-year call option, usually the call options are worthless. They're like 10 cents, 20 cents. So if I bought a call option at 10 cents or 20 cents, it means that since I was bullish on Copin, somebody will be willing to engage with me, thinking that that share will expire worthless. However, of course, 1 year after, Copin shares rallied to as high as about $8, $9, $10. So let's assume that I'm crazy about Copin. That's why I did that. I'll only pay 10 cents. Let's say I paid 10 cents or even at the maximum of 20 cents. I made a handshake deal to somebody. I bought 100 contracts at 20 cents, which means that I have to pay $100, 100 shares times 100 contracts times 0.2, or basically $2,000. I wrote a contract that, hey, give me Copin 1 year from now, let's say July 2021, at Copin $3, and then pay me that. Now, what exactly happened? For $2,000, or roughly 100,000 Philippine pesos, let's say it expires on April 21, 2021, just a couple of days ago. I will now charge you, where is my 10,000 shares of Copin? In Filipino vernacular, magkamatayan tayo, sisingilin kita. nasa na yung 10,000 shares ko ng Copin, which is at strike price of 3. Now, how much is Copin today? It's $8, right? So 8 times 10,000 shares is worth $80,000. Something that I paid for 20 cents today has a rough intrinsic value of 8 minus 3 or 5, right? 5 times 10,000 is 50,000. Technically, what did I do? My $2,000 option gave me a $50,000 gain or a 25x return in just how many months? 12 months. Let's say it's a 12-month option. Or July till April, so 8, 9, 10, 11, 12, 1, 2, 3, 4. 10 months. 9 months. Okay. So my $2,000 commitment, even if you tell me that I have to pay that 10,000 shares at 3, which is $30,000, I am still up $50,000. So technically speaking, even if I don't have $30,000, I could just borrow money straight from the bank, get $30,000 because I'm sure that I have a sitting winner of $80,000. I could just sell 10,000 shares of Copin. Because of that contract, IBKR will give me $80,000, and then I have to pay that $30,000. So my gain is $50,000. Now you only do this if, of course, you love a company and you have a super high conviction bullishness on that company. So technically, the best scenario for calls is really out of the money if you're bullish on that. Now, all right, the thing is that the ones that you're going to learn here is, number one, how do you sell calls for your shares? I'm going to teach you the covered call strategy. How do you collect premiums, or how do you sell your shares at a high strike in a market today where it's a little bit bearish, it's choppy, it's just going buy low, sell high, buy low, sell high. Also, I want you to learn how to sell puts for shares that you want to own eventually. This is more popular because you collect premiums. This is just being able to buy, let's say, Disney at $150, even when Disney today is $180. So how do you do that? Now, there's a question. What if Copin was only 2 after a year? Okay, that means that the strike price of 3 never gets enabled. And since I paid $2,000, I lost $2,000 automatically for Copin. Good question, I forgot to say. So buying out of the money call options will mean that 90% of the time, my out of the money call options will really expire worthless. So you only do that if you have high conviction that the company will actually reach that strike price. But if it never will reach that strike price, the call options, which is just a contract, like a piece of paper, we have a contract. Somebody said, all right, Nikki signed a deal. I paid $2,000 to buy Copin at 3, but today's price is 2. So why would I use this? If I could buy 10,000 shares of Copin at 2, I might as well pay $20,000 in the market rather than my piece of worthless paper of $3, right? So this one, the $2,000 contract that I did to pay $3 Copin is rendered down to the drain or go to the trash can. I hope that was clear. Was it clear? If you have questions, just ask again. So most calls actually expire worthless. So that's the reason why a lot of Wall Street loves to sell calls. Selling calls, because 90% of the time, it goes worthless. It goes to the trash can. Because if Copin right now is 1, who's going to believe that Copin is going to be $3 next year? Or that it's going to be above 3? Even if it goes 3.1, I still made value there, right? But if you think about it, $3 and I paid 20 cents for it, the only time that I will break even on it is if it's above 3.2. Because I paid 20 cents for that premium contract. I hope that is clear. So, all right. There's a lot of questions. Can you exercise a call option before the expiry date? No, you cannot. It can only be exercised on that date. But your calls will go up in value if, of course, the stock price goes up, right? So if Copen was nearing $3, what do you think was happening to the prices of the call options of my Copen? Let's say I made a Copen 100 contracts at 20 cents. Because Copen was nearing a potential value, most likely that 20 cents would have gone up. It will go up something like 50 cents or $1. But of course, when the strike price happens, which is on that exact date of April 21, 2021, and Copen didn't reach 3, whoops, it's 0. So it's nothing. The contract is nonsense. This is a good question because the contracts would have only value if you've got an intrinsic value, but if you're nearer to the date, let's say it's April 20, 2021. So one day before, and Copen is just 2.7. Does the contract have value? Nothing. The contract's value is 0. So the nearer you are to that date, but it doesn't reach that $3, the value of the contract is 0. However, if today if that contract of $3 and I have time, let's say it's January 2021, it's a 3-month expiry. January to April is still 3 months before expiry, and Copen is already 2. What do you think? Those call options wouldn't be 20 cents because it's nearer to the price of 3. Most likely, that 20-cent call option contract would be something like 40 cents or 50 cents for $1. So what will I do? I can just sell my call options because it didn't hit 3, but I can now sell it to somebody and I close my position. I bought a call and out of the money, and then I sold my call and tapos na yun. That's it. Okay? All right. So let's discuss first this question. You sell puts for the shares you want to own eventually. This is more of popular because you're collecting premiums. This one was actually what I taught you when you wanted to sell puts on your Tesla at $450 because they were paying $7 contract. That means that you're receiving for one contract of Tesla. Tesla was giving you $700 for the ability to pay it for the ability to pay $45,000 on expiry date. And then what I just said about Copen is buying out of the money calls. This is a super out of the money and it's super cheap calls like 10 cents, 20 cents, because usually 90% of the time it expires worthless, or if you're right, it becomes a 10x, 20x type of investment. So I'll explain all these 3 strategies. Oh, wait, but before I do that, let me just first answer questions. There's a question here. When the contract is useless, you just own the stocks. When the contract is useless, this is the reason why we like to actually sell calls and sell puts. Because 90% of the time, the contract's useless. That's why we collect the premium. We don't actually buy calls. We don't buy calls. We don't buy puts. What I teach people is to sell calls and to sell puts. Because most of the time, 90% of the time, what you want to do is to just collect premiums, collect dividends. Is the premium paid monthly or until expiry? The premium is only paid until expiry. So it's only until expiry. You get the shares. But when that expiry date happens, either you get exercised, you are requested to buy 100 shares. If it is a sell put, and it hits the strike, or you're requested to sell your 100 shares if it's a sell call. So is the premium paid monthly until expiry or 100 or it's only until expiry? So usually we teach people to sell calls and sell puts 1 month or 2 month options so that it expires worthless automatically. What is the capital requirement needed to sell calls or puts? It depends on the position. So with Copen, you have to think of it. If it's a $10 strike price, it means that 100 shares times 10, it's $1,000. As long as you have $1,000, you can make a 1 contract position on Copen. So of course, if it's a 1 contract of a $100 position or $200, let's say you're doing a $200 sell put on C Limited, you need $20,000 because 100 shares times 200 is $20,000. The amount of money or capital required is dependent on the strike price of what you are selling a strike for. Okay, so I hope that makes sense. Now, what Nikki is saying is that you don't want to buy it at a higher price. So for Copen, if it was only $2 after a year, would you execute the call at 3 for 10,000 shares, $30,000 versus buying it at 2, which is $20,000? So you'll just throw the call. Correct. That's the truth. Yes, that's why it will expire worthless. Are the options automatically exercised on the strike price, assuming the strike price is met? Yes. People will use to exercise that strike price if it's in the money. So naturally, like my example, if Copen was not at $3 on that day, nobody's going to exercise it. So it's just going to be worthless. But because Copen was $8, I would exercise it. And of course, I will ask you to give me those 10,000 shares of Copen at $3 because you agreed that you'd sell to me Copen at 3. So you're forced to give me those 10,000 shares, right? So yes, it's automatically exercised because the rational person will, of course, exercise it if he is in the money. So if you are bullish, you either execute a sell put option. Yes, that is something that we like to do. Sell put option, collect a premium, or buy an out of the money call option very, very far, like long-term out of the money call option. But I prefer actually, guys, to do sell puts rather than buying an out of the money call option. Okay, so let's talk about what if you have the shares and you just want to give your shares at a higher price? Correct question, because that is what I'm going to discuss. That is called the covered call strategy. Selling calls when you already have the existing shares. Now, all these option talk is something that Nassim Taleb, the famous Black Swan trader, actually executed perfectly. This is very simple if you understand what he did. Nassim Taleb believes in what he calls the Black Swan, wherein the unimaginable is actually something that I'm paying a $2,000 risk for, and then if it happens, I get an outsized return. If you imagine, I was bullish on cannabis and I was bullish wearables. So actually, I should have bought an out-of-the-money call option on Hexo rather than buying $10,000 worth of Hexo at $2.50. I should have simply bought, because example, I had $2.50 Hexo. It went to as high as $8. If I simply did a $5 strike price on Hexo, say 3 months, if I bought an out of the money option on that, I could have made like 10x my money in that 3 month span, even if it's so anyway, I'm just giving you ideas because it will prove helpful for you if you want to really say that you're bullish a position and you're willing to hold it, say 1 year forward. So yeah. So I'm only going to do these out of the money call options if I'm very bullish about a certain company going beyond that strike price and staying above that strike price a 1 year forward from now. So there, because 1 year forward, I get to buy the call options very cheaply, something like 10 cents or 20 cents. And then I can execute that right to buy those shares one day in the future because I believe that it will really go 5x or 10x. Now, Nassim Taleb actually famously made the Black Swan trade in the 2008 financial crisis when he bought out of the money puts. I'm not sure if he did out of the money puts in S&P 500. So it's something like this. The payoff is something like this. 90% of the time, if you sell call and sell puts, the typical yields that I teach people is you earn about 5 to 10% month in, month out. So you think about it, if you never get exercised, those shares will just be your shares, right? Well, for sell calls, because I teach people covered calls, the shares will never get hit on the strike price. The high strike price never gets done. Example, if I'm selling calls on Copen strike 10 and current price is 10, current price is 8. if Copen doesn't go above strike price of 10, I'm never forced to give my shares. At the same time, they give me 50 cents. So every month, if they give me 5% yield, if I do this over and over every month, let's say 3 months, even 3 months, I do this, 5% collected. Next month, I sell call again, $10. I collect 5% again. Next month, I sell call again, I get 5%. That means for 3 months, I still hold my Copen shares, and then I have a 15% collection reward already on just 100 shares of Copen. So that's one way of getting income while waiting, while holding, because we're very bullish that Copen will one day break above $10. Now, let's assume that that one day is next month, May 21, 2021. Copen shares are already $10. Of course, I'll probably get exercised. Okay, so this person, I promised to give him my 100 shares of Copen. I give that 100 shares of Copen at 10, or I receive $1,000 of cash. And then, because I received 50 cents before, then I got how much? 1,050. Technically speaking, I sold my Copen at 10.5. That strategy is called covered call. Now, what's the sell put strategy? Because I'm very bullish on Copen, what I will do is I will sell puts at $5. And then let's say I am able to get something like 20 cents, not like a huge premium, but 20 cents at sell puts. What it means is that somebody is willing to give me $20 for every one contract so that I give him $500 worth of Copen. Now, in a single month, if it expires worth this because Copen didn't go below 5, then I just collected my $20. Gets? So I can just do that over and over and over again such that I collect premium either in the sell calls and in the sell puts. That strategy, guys, is called the short straddle strategy. Now, I know it's a lot of jargon, but basically, it works perfectly in a box, which Copen is. Now, 90% of the time, you select this premium. You do this. You always earn 5 to 10% in selling calls and selling puts. Now, there is a 10% of the time, if you are so bullish and you want to put $1,000 on call options out of the money, you could actually earn 100%, 500%, 1,500% if you were the counterparty. As in, the counterparty actually is thinking that Copen's never going to go $25. That's why he's willing to write that. Example, today, Copen is $8. If you think, like we do, that Copen will hit $25 someday in the next 2 to 3 years, we can do this. We will allow ourselves to lose, say, $200. Let's say if it's just 20 cents anyway. Give me 100 shares of Copen at $20 in the next 3 years. Or let's say even at $15, right? I'll pay you $200 right now for the ability for me to pay Copen at 15, 100 shares. So what did I do? I will pay 20 cents times 100, which is $20 for that right. So I'm okay with that. $20 I'm willing to pay. That's how it is. So what you saw in the GME Roaring Kitty was a 10% occurrence. It's like this. You told me that tomorrow an asteroid will hit Earth and everybody will die. Since that occurrence is very minimal, that probability is very small, many will say, okay, I will sell you a $15 strike price on Copen at 2022. That's next year, 12 months. And I'll sell that call option to you for 20 cents. Should you make that deal? Well, if you're very bullish anyway on Copen, you might as well do that. So that gives you the right to buy Copen at $15 once that day happens. So technically, you have to be very bullish when you buy an out-of-the-money call option. Now, this exactly was the reason why Bill Ackman turned the $27 million bet into $2.6 billion. How can somebody 100x his money, diba? How did he do it? Okay, the hedge fund billionaire Bill Ackman was actually one of the few people who minted a lot of billions of profit last year during the coronavirus pandemic, turning a $27 million bet into $2.6 billion simply by, what did he do? He bought, guys, an out-of-the-money put option. He had the right to sell the entire shares of the S&P 500, the NASDAQ crisis, in just a single month, which was going to expire. I think he bought so he bought something similar to what Roaring Kitty did. So how much is it, guys, does it cost if you wanted to enable options contracts? In Interactive Brokers, which is what I use, I need to pay 65 cents per contract. Remember, one contract is 100 shares. So let's learn more, no? I teach people what you call sell put. It's called actually a cash secured put. If I think that the stock prices will fall, but I believe in the long-term appreciation of that. Let's say I want to sell puts on Disney. I want to sell puts at $150 strike. What will I do? I take a look at how much the premium they'll give me, and then the strike price is the maximum loss that I'll do is the $150 minus the premium received. Let's say I collected something like $10 premium on Disney. It means that my maximum loss is if Disney shares went down below 150 minus 10 or $140. So you only do this if you want to do what? You actually want to buy Disney 100 shares, right? So you want to believe that Disney's going to go $250 someday. So this one, usually when you sell a put, it really just expires worthless. So you got the $10 premium, or 10 times one share, one contract times 100 shares, or $1,000. So let's do this in action, guys. So ito pa. I'm gonna teach you many ways to actually avoid getting assigned the stock if you don't have money. So let's say, okay, given Disney example, so you made a sell put on Disney at $150. So you receive $1,000. Let's say you collected 90-cent premium, and in 1 month, right? Let's say, okay, for purposes of example, let's say Disney was just $50, 50 strike. So you sold a put on $50 strikes. Ano ba yung stock? Let's think about a $50 stock, not Disney. What's a $50 strike put? Okay, let's think about Twitter. That's $50 to $60 right now. So Twitter. Or Agora. Okay, my favorite stock, Agora. All right, Agora. So you sold a $50 strike put on Agora at 50. 1 month, May 21, 2021, you received $1. Okay. Let's say Agora tanks next month to about $45. So you're already thinking now, oh no, what if I don't have $50 times 100? I don't have $5,000 to pay this guy. What can I do? You close your sell put by simply buying the same put to close it. Let's say because you're wrong, that because the Agora went down, then definitely the premium that you need to pay to close that put is expensive already. Let's say it's $1.55. So automatically you lost how much? 65 cents already there. Negative 1.55 plus 90 cents means that you close the position simply by closing it before the strike price. Technically speaking, if you close that position before that strike price ends, you can still close it, but we have a loss, all right? So you have got 65-cent loss here. Now, let's assume that you think that, well, I think that Agora will really have, I'd love to buy Agora at $47.50 strike. All right, here's come the roll. You will receive $1.70 from your 3-month strike put. May 21, May is 5, no? 6, 7, 8, August 21, 2021, you sell a put at $47.50. You receive $1.70. Therefore, by August 21, 2021, so you receive $1.70. You are required to pay how much? 100 shares at $47.50 or $4,750. Assuming that after 3 months, Agora never hit below 47.50, you're not required to pay 47.5. So it just expires worthless and you collected the premiums. Total gain is how much? Positive 190, positive 170, which is 260 minus 155. How much was your gain? 1.05, or so that's your total gain, $1.05. Now usually there's a commissions charge. So in Trade King says here that commissions will be 11.20. In IBKR we pay 65 cents, 65 cents, 65 cents. But really the commission fees is not material. All right, so that's how you gain. Now I talked about the short straddle, wherein like Copen, because we think that it's a box, it will not move significantly higher, but it's not going to go significantly lower over the lifespan of the option contract. We want to do a short straddle. We want to sell both a call and sell both a put with the same strike price and the same expiration date. Meaning, May 21, 2021. So actually, a short straddle is selling a call and put with the same strike price and the same expiration date. Usually what I do is not really a short straddle, but different strike price. Let me explain the exact, let's give you exact examples, because talking about this might render you nosebleed. So let's just do it exactly. So here's how you do it. Interactive Brokers. This is how you open an account, log in, no worries. So this is me, log in. We have 15 minutes to explain all of these questions to you. What's the security code? I'm trying to log in. Okay. Okay. I will help you in an exact position. So, all right. So the market is choppy, but we can still be profitable by selling calls. So go to the I'll show you what to do in a market that goes up and down. Okay, so what did I exactly do here? Let me explain this to you. Firm shares, I have it at 71. I've got 100 shares. Why did I sell one contract? It's because it's a covered call, because I only have 100 shares. If I had 1,000 shares, I could do 10 contracts. So what did I just do? I received $2.99 premium. That's my premium price. That's the limit price. $2.99 times 100 means that I paid 200. I got $299, right? $299. So why is it the daily P&L doesn't really matter to me? Because the daily P&L is the price that people are gonna pay for if they want to sell that call option again. So, okay, the call option moves up and down. Why would it go down? Since I was a seller, my motivation is by May 21, 2021, I want a firm to expire worthless. It means that a firm never hit 75. I collected my $299. I collected $300 automatic profit. Now, if that's scenario one, what if a firm share, because a firm shares, that's my strike. It can only do two things. It's either below 75 or above 75. Naturally, if a firm was above 75, let's say it is 76 or even 75.1. So this person can sell, will exercise that right to buy his firm shares at $75. So he will pay me 75 times 100 or $7,500. Will I exercise it? Definitely, because I've got 100 shares here. I'll give my cost of 71 to him, and he'll give me $7,500. So I basically naturally covered my exact, this is a covered call strategy. Every time a firm doesn't strike that 75 strike, it just expires worthless. So I just keep on collecting this $300. Next month, let's say June 21, 2021, I resell another firm 1 month from now at the price. So let me show to you what I'll do again. So click affirm, go again to the options price, click up options. Next month, let's say June, I would choose to sell another call option, perhaps at 75, or let's say the prices went higher. I want to sell a call at $80. All right, so click that. I don't want to sell a call option if I don't have the shares, because if I don't have the shares, I could get a GME squeeze and I don't want that to happen. So here you could see that it's a $3.30 frozen data. So it just tells me that next month, if a firm I want to sell, I can collect $3 premium. I could get $3 or $330 for an $8,000 position. So that's great. So utilize this as long as you have 100 shares of that stock. Now, let's talk about more ideas. All right. So what did I just do here? Let me explain to you about the Arc Genomic Fund. Okay, what did I do here? Looking at this, you might think now, oh, she lost 51%. No. What it's only telling you is, I have 100 shares of Arc Genomic at 51. So I've got $9,100. What I did was, I sold a call at $2 for just $200. I got cost basis $200 for just $2. I was willing to already give my shares at 90, which means that 90 plus 2, 9,200. I don't want to wait for May 21, 2021. I want to sell my Arc Genomic Fund as soon as I can. So I chose a call option that is nearer to the strike price. So I chose a relatively low strike price so that it gets exercised. I wanted to make sure that by May 21, 2021, he will definitely, hopefully, he will definitely exercise this right so that I will eliminate my 100 shares and automatically he calls me out, gives me $9,000 so that my cash pile increases. Why would I do that? Because right now, my total cash margin is $35,000 or about 15% of my total market value. I want to actually get my shares exercised. Now, let me share to you a few things. Okay, ASXC. This is a Census Surgical. Take note that I am not willing to sell any price here. I chose a different strike price, a very high strike price of 2.5 and a very long dated option in the sense that right now it's April. Why did she choose July? That's still 3 months from now. I wanted to collect as high of a premium that I could. That's why I wasn't willing to sell at a very low, I wasn't willing. I was looking at the prices at 2.5 because the prices is 1.9. It's not easy to find a good premium price because when you're doing sell calls, you want to achieve a high premium price. Like what I did was I collected 24 cents, not knowing that somebody was willing to give me 30 cents anyway for it, or $300. Nonetheless, that's the reason why there's a $43 here. What it's merely saying to me is that I received $244, but technically speaking, someone was willing to pay me $300 if I only waited a single day after. So anyway, these 18% or 14% here does not matter. What I did was essentially insure myself because what happens then? Guys, what if ASXC, this 1.9 falls 1.5 tonight? If this one falls 1.5 tonight, that means that this 2.5 call will be as much as possible worthless. Meaning this 30 cents goes to zero by July 16, 2021. This 50 cents goes zero by October 15, 2021. At least I got how much? $3,700 or about $3,800. What I did was whatever the stock price does, I automatically cap my losses at just 3.8. So I was actually doing a fixed loss. But what happens, guys, if ASXC did the different round? It went $2.50. What happens? At that time, if it's $2.50, this person will naturally exercise, right? He exercises it, and then I sell my 9,000 shares to him times 2.5. I make a gain, and I receive this collateral, this premium. So this best case scenario, really, in a sell call, is to get actually called out. But the other nice proposition is that while I'm waiting for my strike price to get called out, I'm also taking these premiums. So I'm collecting premiums. That's the beautiful thing about collecting premiums. Okay, so let me explain what to do. Example with Alibaba. Let's say I'm very bullish on Alibaba. I want to get 100 shares of Alibaba at the cheapest price possible and get paid for it. What should I do there? Alibaba right now is trading at $230. So what I should do if I want to buy Alibaba is to find the put option. So let's go to Alibaba, click Alibaba, New York Stock Exchange, click options. Today is April. I want to find the, let's say 2 months. I want to get a $200 or $195. Since I want to buy this, I need to sell a put. I need to find out how much does it cost for me to buy shares of Alibaba at $195 and how much will they pay me for. So let's take a look at the June 4, 2021 put option. Says here it's $1.20. What does it mean? What it means is if I were to sell a put on Alibaba, they'll only pay me $1.20. How much is the yield there? 1%. Doesn't even hit 1%. So is it good? No, not a good deal. Why do you think that even if I wait June 4, 2021 or 2 months from now, that I'm only going to receive $120 for $19,500 commitment? Why is it too small? 1% yield. It's because nobody actually believes that Alibaba will go down below 195. That's why I'm getting such a small premium. Now, let's assume that I want to buy EHang. Okay, take note. EHang has fallen from $120 to as low as $26. Since it's in a downtrend and I want the company anyway, let's say I want to buy EHang at $20. What I should do is try to find the sell put option. I look at the options of EHang. I want to buy it, let's say, at $20. Put option, let's say next month. Next month, how much do you think? Okay, it's 95 cents. What it means is that he is willing to give me almost 5% yield because it's almost $1. 1/20 is 5% yield. He's going to give me $100 for a commitment to pay EHang $2,000 worth by May 21, 2021. Why would I do that? Because I believe that EHang is bullish long-term. Now, if I'm not bullish on EHang long-term, what will I do? Take a look at the option chains. So there's a lot of strategies. If I have EHang 100 shares, what should I do? I'll show you what I did. Because I have that there. Let me show you the exact thing that I did with EHang. This is my EHang position. I've got 1,000 shares at $31. The current price is 26. So most likely, this sell call option means that, what did I just do? I have the option to sell my EHang at $30 because somebody bought that call from me. Okay? Somebody said, all right, Nikki, I will buy your EHang at $30 on May 21, 2021 and pay you how much? $2. And I said, okay, deal. I got how much? $200 times 5 or nearly $1,000 for that contract, such that he will take away my EHang shares on May 21, 2021. Now, let's say it expires worthless because EHang on May 21, 2021 is still 26. So what happens? I pocketed that $1,000 gain. And this one, take note, I was willing to actually sell also my EHang at 35. And a poor soul actually gave me how much? He gave me about 500, he gave me about $350, no? So, because I made a 70 cent contract. 70 cents times $5 is 5 contracts is 35 times 100 shares, so that's 350, right? So there. So 0.35 times 100 is $350. So he gave me how much? $1,250. What if on that day, ihang is 32? Definitely at 32, this one will call me out. Fine. I sell it to you at $30. Did I lose? No. 30 plus 2 is 32. I would have been the same price. If I sold it at that day, 30 plus 2, 32. I would have sold it as well at that time, 32. Now, this one, do you think he will exercise? No, because it's 32 eh. He made a sell call at 35. So this expires worth this. I really collected this $350 premium. Okay? So that means that for all your existing positions that you want to sell shares for, find the best premium price for them, get the contracts, and get a strike price that is nearer to the price, but find the way to actually find these types of deals. So because of volatility, there will be these types of deals. Do we need to confirm or click anything when the strike price is exercised, assuming the strike price is met and the strike date is due? No, nothing happens. You don't need to click anything. During May 21, 2021, if the strike price of $30 is achieved, automatically 500 shares of ihang will be exited. So your 1,000 shares here will become 500 shares. If the price was $30.50, example, or 30.01. Now, I'm going to show to you just exact examples. What if I sell a put and I just don't want to exercise it anymore? I'll tell you what I did a couple of weeks ago in an exact trade. Let me show to you what I did with. So I did this one. Take note. What did I do here? Did you notice Roblox? Okay. For this exact trade, I made a sell put. So here's what I did. On March 19, 2021, when the market was collapsing, I made a deal of the devil. I sold a short, I sold a put, meaning I'm willing to buy $55. This was a $55 strike contract on Roblox. See? $55 put, I sold it at $4, right? $400. Now, because Roblox shares went up, the likelihood of Roblox going 55 is becoming nonsense because Roblox is still trading at 75. From March 19 to April 16, with just one week left to expire, within 1 week left to expire, it's becoming worthless, right? It becomes worthless. So actually, right now, this one at $1.25 will become going zero. Why? Because for 1 week time, for 1 week's time, do you think that Roblox will collapse to $55? Perhaps not, right? So yun. Right now it's 70. Actually, you will still receive 125 if you want to sell put on it, and that's actually a good premium, given that it's just 1 week from now. From one week from now, if Roblox never fell to 55, that sell put is worthless. So that sell put is worthless, and if in case that it does happen to be below 55, what do? You pay 55 times 100 or $5,500 for Roblox. $5,500 minus 125 is 5,375. Your technical cost on Roblox is 53.75 for 100 shares. So I do the sell put strategy when I like the company. So I want you guys to take advantage of all the opportunities that are there in the market, whatever your stocks are. So I always will tell you what to do. The first thing to do in a market like this is I tell people to take a look at their largest positions. So CD Project, I can't do a sell call, sell put, so I can't do anything about this. So far, I just keep it there. Even if this looks like big, this is 60,000 Polish zloty. This is actually just $6,000. I think, no, sorry, it's about $18,000 because Polish zloty, PLN to USD is about 20, so that's 30%, right? So 26. So if I have 60,000 times 0.26, that is mga $15,000, right? 60,000 PLN to USD. How much is that? $15,000, $16,000. So it's about how much? Percentage, it's $60,000. So it's big, but I can't do sell calls, sell puts there. So I took a look already. I couldn't do a sell call on CD Project. I took a look at the options. Now, this is something that I could do. Did you notice that FUV, I have a huge position. It's 4,000 shares. So, of course, the only reason why I have 4,000 shares in FUV is because I really believe that long-term, it's fine. Now, assuming that I don't want to sell FUV anyway at a loss, what should I do? Right? What should I do if I like FUV long term, but the market is punishing me for my bullish position on FUV? This is what I did. I sold 20 contracts at how much? $12.50. I allow you to get my shares at $12.50 and pay me 50 cents. Or technically, I was allowing them to give me $12.50 plus 50, which is $13. I was willing for them to take me out at $13 effective sell price. So do this, Global Star. I have a cost of $1. Let's say I just want to sell it at $1.05. What do I do? Take a look at the option chain. So right now, you've got May and you've got June. So let's try to make it June. I want to sell it at 1. Let's say, well, look, the premium is 15 cents. So he's willing to give me 15 cents if I'm willing to give him 100 shares of my GSAT. So notice that the lower the price is, the higher the strike price is, the more that it will expire. So I would prefer, example, something like this, $1.50. It will expire worthless, right? I sell a call, even if I'm just receiving 10 cents for it, which is just $10. Since I think that it's almost worthless, I'd still receive $10 rather than nothing, right? $10 times, this is just 100 shares. But if I have 10,000 shares, then I could sell 100 contracts, right? 100 contracts times 10 cents, which is $10. I still receive $1,000 simply by allowing him to take me out at 1.5. That's a great deal. What did I just teach you guys? Collecting money simply by selling shares that you existingly have. Great, all right. I hope that it doesn't make you nosebleed. But this is really a great strategy when you have the shares of GSAT and you just simply want to sell it at $1.50 or $1 something higher to get you out of your shares at a price that you like and get paid for it. Roaring Kitty did, he bought calls out of the money options. So it's something like this. I'll tell you what. Example, I think, let's say that I believe that, let's assume that we think that Copin, because we are very bullish on this name, we think that Copin will actually reach $20 next year. Okay? So right now it's $8. So take a look at the option chain. First, you have to understand the strike price. So first, let's type in Copin. I'll help you if you are very bullish on a company. This is how you do it. I want to see the Copin options. I want the strike to be high. Okay, let's say, because it's $8 right now. Let's say I want the strike price January 21, 2022 at $10. Let's say I'm very bullish that this company will actually, wait. This is, where am I? Am I in the call or am I in the put? Wait, I have to, let's go first to the portfolio. I like to type it in. Yeah. Okay, January 21, 2022, I want to find since I need to buy, so I need to look at this one, right? Buy calls. Here at 10. So right now, actually, if I were to buy, he's asking me to pay high, $2. So that's pretty high. I wouldn't pay for that. This one at 20, I need to pay $1. So I don't want to pay for that either. 2023, let's say dito na lang. Let's see how much the strike price of buying a call option at, okay, here, this one. Let's take a look at this $12.50. So naturally, guys, when you're buying out of the money calls, so this is 8, right? So the out of the money call is how much? This one, right? The $1. You know why I don't want to pay for that? Because for the attempt to buy open at $10, I need to pay $1. That's why I've been selling calls. What did I do in Copen? I've been selling calls at 10, receiving 50 cents, $1. I've been selling calls kasi I have 100 shares. This one is the out of the money, $20. This $20 means that in 90 days, today is April, right? In 3 months time, if I pay for this 20 cents, I'm paying $20 per contract, but I have to believe that Copen is gonna hit $20 by 3 months. So technically speaking, because I think that is a very low occurrence, that is a black swan occurrence, I don't want to do that. So if you notice, all I did, guys, was sell calls. I didn't buy out of the money call option. Okay, last thing to do. There's just last 2 questions. How determine which strike price to choose? Actually, guys, I choose the strike price that makes the most sense in terms of the chart. Sample, I'll take a look at the chart of Copen. Why do you think I chose the $10 strike? Why $10? Because if I look at the chart of Copen, it's an obvious 10 to 11 sell ring resistance. You want to choose when you're selling a call where the resistance lies, not where you think that you can sell upon. Why would I choose 10? Simple. This is the strike price that I want to sell into. I want to sell near 10 to 11, right? So I want to sell at 7, right? So I want to sell my strike price at 10. Now, that's how I do my sell call. Now, let's say I want to buy a company. Where do I want to realistically buy? Hopefully at 7, right? Or if I could buy near 5. So when I want to make a sell call, what strike price should I do? For selling calls, I need to find a $10 strike. For selling puts, how much should I do? Either I sell a put at $5 or I sell a put at $7.50, something very near. Okay, that's really how you do it. That's how you determine your strike price. And then you actually determine your limits by 10% yields. I prefer getting a 10% yield when I collect my premiums. All right, last questions. I read in IBKR that your liquid net worth should be $100,000 to use this strategy. Does it mean that you cannot do it if it's lower? That's not true. As long as you have a trading permission of, I never tried it with a $10,000 account, but I've tried this with $60,000. Actually, I never checked what is the minimum account to do options, but you can try. Trading permissions, what you need to only do is click trading permissions. Okay, let's say you are a new account, you don't have it available yet. This is what you do. Try typing trading permissions. In trading permissions, you can select request trading permission. In order to do the things that I'm teaching you, you need to have options enabled. You have to have options enabled. So, diba, take a look at what I did. Request, configure. This is what you need to do. Have high number years of experience, make the maximum, 10 years of experience, 51 to 100 trades per year, make it good knowledge because you're an awesome 10x investor. Now, options, you have to do it very high too. So permission to trade, US, Mexico, Canada, Australia. Click all of that and then press continue. And then you'll sign. Ayun, options experience. If they ask you to take an exam, then take an exam. Don't worry, it's easy. You just do a Google search. Your request to change trading permissions has been submitted. It's fine. I wasn't really changing my permission. Yeah. Basta you ask for permission, you can do that. Okay. What is the difference between buying puts and calls versus selling puts and calls? Buying puts and calls means that you have to pay it. We don't want to pay. That's why we're selecting sell calls and sell puts, because we want to collect the money. Selling calls is writing the position and getting the money. If you buy the puts and calls, you're actually paying for that. You don't want to buy puts and calls. You actually want to sell puts and sell calls. What does it mean below 1 is good price or above 1, like 1.95, is expensive? Huh? I don't understand the question. When is it the best time to sell put? Sell a put option. If you sell a put option, guys, if you see that you want to buy the shares of the stock at a really good price. Sample, Copen. I sell a put if I'm bullish. I'll tell you what, example lah. Why is it that for Alibaba, even I like to buy it at $200, why did I not do it? Because he was only giving me $1. I tell you to get 5% yield, which means that at $200, what is the 5% yield? $10. I'd only be willing to sell put on Alibaba if you'll give me at least 5% or $10. If you're going to just give me $1, doesn't matter. So I wouldn't care about it. I sell a call when I think that you're giving me a good price. Sample, I have Alibaba. Let's assume I have 100 shares of Alibaba. I could see that the resistance is 260. I could be willing to give my shares to you at 260 or even at 244, let's say. Let's say I don't need to sell it at 260, even at 244 because the price is 230 right now. As long as you give me $10, I will be willing to give you that share of Alibaba of mine at 245. So 245 plus $10, that means technically speaking, I sold my 100 shares of Alibaba at 255. So that's how you do a sell call, sell put, at least 5 to 10% yield. But I want to preferably 10% yields. So there's small red now for the stocks. If I want to buy shares, I'd rather sell put than doing it the norm. I want to hit it, of course. That's acquiring shares plus a premium, tama ba? Right now, because the market is falling, you have to really sell a put. And did you notice that what I did was I kept on selling puts on Tesla, on Roblox, on C Limited. I wasn't, because I could really take advantage of the premiums that they were willing to give me. So that's one way to actually get the premium. That's how you make your profit. Because if the shares fell down, at least you want, let's say you wanted to buy Alibaba anyway at $205. Why will you post 100 shares at 205 when you can just simply sell a put at one contract at 205, wait for the contracts to expire? Two things happen. Either Alibaba does go to 205, you get that expiry date, you get exercise, you pay $20,500, but you collected the premium, which theoretically, if you're using my analogy of getting $10, you still got $1,000. So 205 minus 10, your real cost is just 195. So do the sell put strategy if you want to buy the stock. Do the sell call strategy if you want to sell the stock. Recall that I told you guys this one in this exact class, selling puts and collecting awesome 10x winners. This was the exact class. It was also a free Friday class. Selling puts option as a strategy and collecting winners. March 19, 2021, go back to this class, guys. So I taught you guys how to do selling puts on Tesla. So I think I taught you how to do that. Tesla, Palantir, because I like those companies. So this is the exact thing that I did. So here, Tesla, Zoom, Palantir, Tesla, Teladoc. Those are the companies, Shopify, that you want to make a sell put strategy on. That's it. I hope that you learned something. If it's a little bit I'm not sure if I was able to really explain my ideas, but that should work. It just expires worthless. Similarly, before I end my day, this is what I can also help you with. In eToro, you can actually do a simple short. Let's say you don't understand this call options, put option strategy. You can simply do this one. In a sell-off, in a selling market, you can easily sell shares if you think that it's going to go down. So Vesta, Siemens, what did I just do? Take note, my stop loss here is $16.55. For $500, if I'm wrong, I lose $250. If I'm right, it's up to me how much take profit I want to do. So it's very useful in crashing markets. Example, I think that Ethereum is expensive, that it should fall. What should I do? Simple. I sold my shares of 2.3. My stop loss is 3,450. What does it mean? If Ethereum goes 3,450, I lose what? I lose $750 of my money. But if Ethereum crashes, how much will I make? Depends on how much I want to take profits from. So Ethereum, Vestas, Unity. Well, Unity is long. I'm long there. But I'm selling Ethereum like these ones. I'm also selling Booking. I'm also buying Tencent. So you'll notice that there are some positions that I'm willing to buy and there are some positions that I'm willing to sell. Why do you think that my eToro account is a buy and sell account? It's because the market is choppy. If it's very low, I will buy. If it's very high, I will sell. That is a recipe of what? It's a range trading market. And I think I remember telling you how to trade in the market like this. Aside from this, selling put options and strategy, collecting awesome 10x winners, try to go back to this class. Go to this class. If you're an awesome 10x Inner Circle member, go back to this class. How to profit from a market crash in a potential peak in 2021. I discussed it in March 18. I also discussed it for awesome 10x. I discussed it in March 18, 2021. For the Lady Traders Confession, I discussed it actually on that Saturday, March 20. I discussed how to actually profit in market peaks, how to make money. So you'll make a lot of money selling calls and selling puts. You collect premiums. And if you really want to make a real sell, just short it. So shorting it means that you just have to be aware that your stop loss, just like this one, there's a stop loss strategy here, 16.55. Now, I know that it's a little bit weird though why the stop loss is too high. It's because you don't want to get taken out of your short. And you only short company if you think that it would have a bigger downside rather than an upside. So let me explain why I shorted Vestas. You'll notice that this one is a company that everybody loves because it is a bullish stock. This one is actually bullish trend, right? But from about $500, Vestas hit 1.6 or times 3. I think that for this year, what's happening in these great companies, these renewable energy names, they're actually stuck in a range. What you want to do is sell near 1.4, or in this case, 1.3. I sold it at 1.340 today. And then where will I cover? In case you're wondering, I'm going to cover it somewhere here at about 1.2, which is a 10% downside, or I'll cover it somewhere here at 1.1, and I'll cover it at 1,000. So what does it mean? I'm not really foreseeing that Vestas will crash all the way to 600. All I'm foreseeing is that 1.4 to 1.6. I think that is a high-end zone. So you want to sell high. And then 1.1 to 1,000, that is a low-end zone. You want to buy low here. So if you take a look at the price performance, all of the companies that did 5x or 3x in a couple of in less than a year is actually getting this type of correction, whether it's a 40% correction or it's a 50% correction, or if it's a penny stock, it can correct 70 to 80%. So what I'm doing is, if it's just very small drop, like this one, it's just 18% drop so far, because I'm predicting that the market will fall, I shorted while it was just down 18%. Let me give you more ideas for what I did. Not just ideas, something that I really did. Why do you think that Booking.com I'm selling? This is a short. Booking.com I shorted. Square I shorted. Let me explain what I just did there. Square right now has gone up. Of course, everybody loves this company. From $40, this rally to as high as how much? Times 7 to 80. It's barely corrected. Barely corrected. Me, I tried to short 247 or 242 because it's just 13% from the peak. All I'm assuming is that Square doesn't break above 280. So take note that even when I'm shorting, there is a stop loss. This one, I even need a stop loss at $300. So when you're doing shorting, it's kind of the same with buying stocks. You're just doing it inverse. If the stock prices, if you're buying a stock, when you're wrong, diba, it goes down, you stop loss. In a sell or in a shorting environment, when you think that the stock has already gone up so high, and you think that it should fall at least 30%, or I think like Square, I could probably buy it at $200. I need to short it at 250 or 247 and then buy it back at $200. So that's my theory on Square. For Booking.com, it's the same thing. And Tapestry, this is something that I'm shorting. Take note that I saw a double top here at Booking.com, which is a 2.5. I'm willing to actually close my position and short. Why did I short my Booking? Let me tell you how I did. You can short, by the way, in eToro and IBKR. It's fine. I forgot. I shorted Coinbase, actually, in my IBKR. Didn't show you. Last but not the least, everything has a stop loss. Let's say you don't want a tight stop loss. I don't like to make tight stop loss. Actually, that's why when I close my eyes, my stop loss is very high. But some people have a stop loss like 2.5 or 2.550 or 2.6. My stop loss is really high because I want to manually close my positions. Because if I'm really bearish a company, I'd wait for the market to tell me that I'm wrong. So, okay, Booking.com, where will I cover in case you're wondering? I'll cover somewhere here at about 2.2 and perhaps I'll cover somewhere here at 2,000. If you take a look at the risk reward of what I'm doing with my shorts, if I'm right that it collapses, it can either go down 9% or 10%, or it can go down as high as maybe 17%. What if I'm wrong? Look at the downside risk. It's about 6%. So all the time, if I'm shorting, it's all about risk reward. If I'm wrong, I need to cover at 2.5, 2.6. If I'm right, I need to, what's my reward? This one and this one. So when I'm shorting or when I'm longing, whatever trade I do, it's all about risk reward. Nothing else. That's all. Okay. Ideas on Humble. Sorry, I know it's already late. For Humble, it's obvious that it's already a downtrend. So what you want to do here is to short it. You don't want to go long in it because it's very clear already that it is a downtrend. Remember when I shorted, I didn't short because I was just selling my shares, by the way. I sold my shares actually very early on Humble. I was selling at 5, it went to 6. I still told people to sell it at 6. Because, of course, big move. I mean, if you were buying at about 3 and then it's already at 6, that's a 100% move in just 2 days. Of course, it's obvious that a trader or even an investor will sell it. So sell 5 and 6. Okay, because that was just a change in ticker symbol. Then there's this reverse takeover. Now, you saw, again, 250, rallied to 4. That's a big move, so I sold again. Now, this is so sell. Now, right now, because it always gets supported at 250 and 270, what I did with Humble is I bought it again at 2.7. It rallied to 350. However, I wasn't prepared to sell it the next day at 350. So it went up to 350. The next morning, I woke up. It's already at 280. So I wasn't able to sell at 350. I wasn't able to sell at 280. The next 2 days, Humble Pay dropped 50% significantly to 280. It even dropped more than 140. It even went as low as 120 here. So from 280, it fell to 140 or 120. At these levels, I didn't sell. What I did was, I bought actually, seeing that there was a bullish candle here and it was so oversold. Why was it a buy at 120? Even if you don't know the future, because I was already recommending that 120 or 150 was a buy. Because I said, well, if it fell, there were only two occurrences for Humble Pay to go. It's either it goes to $1 or 55¢. And in my view, if it fell $1.55, I was very willing to buy at $1.55, even if I had a cost of $2.70. So I was averaging down. Now, of course, after averaging down, what is the next move? It already bounced to about 180. From 120 to 180, that is how much? 50% up. I was aware that there's a lot of resistances. So for Humble Pay, it's obvious that if the market's gonna collapse tonight, you cannot sell it at 250 even if you wanted to. So you need to sell near 170 today. Now, you sell 170, and then what happens if it goes up tomorrow? Let's say next week, it goes up to 190. The beautiful thing about US is that shorting is allowed. Let's say it goes to 250. What do? You short your shares. Or if you don't have it, I'm okay to do a naked short. Why do you think I'm okay to do a naked short on Humble Pay? Because it's very clear there is a downtrend here. Everyone who bought here is what? This is a trap. This is ipite. 350, right? If I short at 250, where will I cover realistically? Where is my stop loss? 350, right? Okay, what if I'm right that it really goes down? What happens? 250 collapses to $1 or 150 or $2, I make 50-cent profit. So that's how you do it. In order to make money on a downtrend, what's the likelihood of making money in a downtrend? Shorting. Selling, shorting, selling, shorting. What was this? A counter trend rally. What do you do in a counter trend rally? Sell it. A counter trend rally is an opportunity to sell and to short. It is not an ability to buy. So that's what you do on Humble Pay. Thank you very much. Bye-bye.